Welcome back, traders and investors. We have a returning guest, Ryan Detrick, independent trader and market technician. And with the S&Ps trading up within a point of the new all-time or the prior all-time high, 1978 and a quarter. How you doing today?
I'm doing well, Joel. Thank you. I'm honored to be back and looking forward to talking markets with you today.
Okay, we enjoyed your insight last time, and now we want to dig into something a little bit more specific here. And this is something that you've been working on and talking about the SIBO options equity put call ratio. So, talk about a little bit what that is and what you're getting from it.
Sure. Well, the simplest way to put it, the CBOE equity only put to call ratio. Again, like it suggests, it looks at just equities, and to keep it simple, which is what I usually like to do. I do a 21-day moving average, and the trend of this is usually the most important thing. When this ratio is trending lower, which it had been for the last couple of months, we've had this good run. That's usually indicative of a good bullish market. That's what we had. Now, what concerned me, I've been saying for a while, this ratio is at the lowest level it's been in many years, in about 3 or 4 years, actually. So, it's getting low. Now, what does that mean? Well, maybe there's a lot of optimism. A low put-to-call ratio would suggest, hey, maybe people are a little optimistic. Just because you're optimistic doesn't mean you have to be bearish, though. And now, though, what's happened that's concerned me over the last week, this ratio has actually kind of started to turn higher. And sure enough, with small caps last week had their worst week, in 3 or 4 years. So, it comes down to, hey, maybe there's something going on here that is starting to go higher, and that is a concern. Bigger picture, yes, I'm bullish. I can give you a bunch of stats why. But near term, this ratio turning higher from low levels says maybe there's some volatility going to come. Look at the last 30 years. August and September are hands down the worst 2 months. So from a purely seasonality point of view, that's not really in the bulls' favor. This ratio is a concern. One other concern that I have, if you look at the Investor Intelligence poll, which just came out again this morning, but recently we've seen a spat of over 60% bulls, and that's pretty rare. I did a study just last week going back to 1970. That's only happened 134 times when you go out 1 year. To keep this simple, a year later, after the Investor Intelligence poll is over 60% bulls, out of those 134 times, the S&P is just up 3% on average a year later. 6 months later, it's up about 1%. 3 months later, up about break even. So again, this is showing there's a lot of bulls out there. Now, that's not by itself bearish. That's an important thing to note. But it is, as a trader, you pay attention to these things, and there's some reasons in my work that say, the bull market is alive, but be a little leery the next couple of months, is my opinion.
Okay, so the Russell here, quite a ways off its all-time high here, putting in a pattern. I don't want to call it really a head and shoulders kind of week. So what you're with this very high bullish sentiment and the small caps of the Russell not busting out the new highs along with the rest of the market, that is the cause for your concern.
Absolutely. I mean, and again, what we saw recently when the Russell was down 2 straight months, yet the S&P was up 2 straight months, I guess it was April and May, we can have times when there's small cap weakness. Usually we all say small caps are the canary in the coal mine, whichever way they go, the overall market goes, but that's not always the case. And, from a contrarian point of view, when you look at what Yellen said yesterday, she's giving concerns about small caps. And we all have seen the history of the Fed when they make market calls. It's not always the best. So my contrarian indicator started going off, and I agree with what she's saying. But yeah, I do think from a bigger picture, back in March, the Russell 2000 was actually 40% above its 200-week moving average. That's helpful. But I did a bunch of studies then, and it was very bearish results going out. The Russell is historically overbought. And really, you look at it for 14 years, the Russell 2000, small caps have led. And back in March, I kind of made a call that said, hey, maybe this is finally going to start to unwind. It finally is a little too overbought. And you look at what's happened, and so far that's playing out. My take is that this very well can continue, this being small caps continue to kind of underperform. But the big blue chips, the boring blue chips that we kind of wouldn't say left for dead, but many people have ignored, that seems to be what people are starting to gravitate to. And who knows, maybe we could have a decade or so of underperformance with small caps, outperformance from big caps. I think that could be what we're moving into. But Near term, that Russell 2000 had a double top around 12, just above 12,000. The relative weakness on some oscillators I look at, sentiment, like we said, kind of bullish. All in all, be leery of small caps is my take, but blue chips seem still pretty good.
Okay, so let's talk seasonal patterns here, and I see you've done some work here on the S&P 500 over the last 30 years. August and September not looking so hot. Actually, besides those 2 months having negative average returns, June was about flat. So, with the weakness in the small caps vis-a-vis the big caps, the seasonal patterns coming up. We all remember September of 1987. A lot of different things going on. Is the seasonality causing you for a little caution in the market as well?
Yeah, when I consider everything and mix it all together, no question seasonality is in there and it's a concern. You just mentioned 87, and I just had a couple people on Twitter remarking how the market's up and just wait till there's a 1987 crash. If you remember back last August, we heard a lot of the same things, and that there's going to be an 87 like crash. We're up too far, too fast. And the one major difference, in my trading, I look at technicals, but I like to look at sentiment. And one big difference, if you look at what's going on now with 87, why I don't think we'll have an 87 like crash, the big trade in 1987 was OEX put sells. Just print some money every month. Continue,
Yeah.
a put sell by itself, keep it simple, is like a neutral to bullish strategy. You just don't want things to go down. And people are just printing money every month. They continue to do it. Look at the big trade that we have this year and what we've seen the last couple of years. In my opinion, it's the VIX calls. People continue to hedge against volatility. Now look at those two trades. One is bullish. The other is, a hedge. I wouldn't say it's outright bearish, but it's a hedge. So just from a bigger anecdotal point of view, the two trades, there's a big difference. And I pointed this out 12 months ago that there was a big difference why I didn't think we have an 87 like crash. And it didn't happen. And I still don't think we'll have one this year. Doesn't mean we can't finally get that elusive 10% correction, over the next couple months. But still, I don't think we're going to have a one-day drop like 87 crash, honestly, because too many people are still hedging against future volatility. And from that contrarian point of view, I still expect overall lower volatility.
Okay. Just real quick, S&Ps tried to crack 1978 and a quarter. Sellers stepped in ahead. 1978, the high here so far in the session. 1975, a weak number, a pre-market low, but getting a little bit of a bounce. So for now, 78 and a quarter still holding up at the all-time high. Big news on Beamer and Apple. Those kind of opened up near their highs as well, missing their pre-market highs, selling off a bit. Back to you, Ryan, and you always hear the low volume argument. You've been hearing it for years as the markets rallied, and so maybe the volume's not in the stock, but it might be in other instruments. What's your take on the low volume argument?
Sure. Well, the low volume argument, I remember back in, I think it was September 2009, doing some bull bear debates, and I heard it clear back then that, volume's light off the lows and it's a bearish sign. And, fast forward 5 years, we're still hearing the low volume. And if you look at, NYSE volume, SPX volume, SPY volume, yes, they are definitely, it's been trending lower for 5 years. But when you look a little deeper, the thing that stands out to me, if you look at the average futures volume the last, really 5 years, it's significantly increased every single year. And if you look at options volume, it's also been a steadily increase. I talked a little bit a second ago about the VIX. So we've got huge options, going off on VIX calls, and VIX puts been active, but mainly it's VIX calls. My take is if you look at who's left trading these last 5 years, we know we lost, I guess you could say, a generation of investors or a lot of retail crowd. The people who are left are more sophisticated. And, they're not just buying stocks. They are out there using options, using futures, with a lot of action in bonds and gold also over the past 5 years. So just because we hear volume, quote unquote, is light, to me, that doesn't really matter like it used to. I hate to say it's different this time because we all know what usually happens when someone says that. But honestly, it just seems like the volume, instead of being in stocks, is moving around. And that's, it's not a good thing. It's not a bad thing. It's more just a fact, in my opinion. And that's one reason for a while now I've said don't pay so much attention to volume. The old saying as a technician, only price pays. And you can talk about volume all you want, but if price continues to be strong, that's what really matters, and that's where you're going to make your money. But hey, it seems to me like it's going other places.
Like we like to say in the show, price don't lie, and
That's right.
and that it's telling the truth here. S&P's trading off 8 points. Well, coming down to the end of the interview here, Kevin, I'm sorry, Ryan, you've talked about a lot of different things here, and the market toward all-time highs here. Give us, your short-term view and a little bit longer-term view.
Well, sure. Like I said, short-term view seasonality is a concern. Some of the over-the-top sentiment that we're seeing is definitely a concern. But bigger picture, continue to think this market looks very good and should definitely continue to go higher. Lastly, I just did a study yesterday that's pretty cool. The S&P's been up 5 straight months. I look back since 1970. That's happened 22 times. 1 year after the S&P was up 5 straight months, so in this case, starting the 1st of July, the S&P was higher 21 out of those 22 times, so higher 95% of the time, up about 14% on average. And the one time it was negative, it was actually, again, a year later, it was down just 0.6%. So, there's different ways to look at things, but the bottom line, there's a lot of momentum to this market. The fact that we're just up five months in a row actually is extremely bullish, 95% of the time higher a year later. So that's just one stat, but it's a neat one. And it says this momentum is still here, in my opinion. I think a year later we'll be higher than we are now.
Well, Ryan, you do your homework and you come up with some amazing statistics and helps you form a strong opinion on the market. We appreciate you coming on to Benzinga's Pre-Market Prep, brought to you by Options House, giving us your takes on the market. We'll let you get to the markets right now, and we hope to talk to you again soon. Thanks a lot, Ryan.
Thank you, Joel. Look forward to it.